Welcome back everyone to CrowdWise Academy. This is Brian Belay, and we're kicking off the Level 1 course for novice investors today with Module 1, which is going to be providing an overview of equity crowdfunding. In Module 1, as we mentioned, we'll be giving a brief overview of equity crowdfunding. In Module 2 of the Level 1 novice course, we'll be getting into investing fundamentals, covering topics such as asset allocation, diversification, risk versus rewards, and other fundamental concepts that will help investors before moving on to the intermediate and advanced courses. An overview of today and what we'll be covering. First, we'll be discussing what is equity crowdfunding, the different types of crowdfunding, as well as regulation crowdfunding and the Jobs Act. We'll discuss why should investors be interested, since it is a new asset class, and what the potential risks and returns of it are. And then the types of investors who might want to get involved, and what your investment reasons are for considering equity crowdfunding. Lastly, we'll discuss some current obstacles as of early 2019, and then we'll talk about how and where to begin. So at the top level, crowdsourcing can be grouped into two primary buckets. First, there are all the ideas, brainstorming, problem solving, and basically any other types of crowdsourcing that are non-monetary in nature. The second bucket is basically anything involving taking money from the crowd, and that's called crowdfunding. Now, equity crowdfunding is a subcategory within that. So within crowdfunding, there's rewards-based and donation-based. These are the ones you're probably familiar with, such as Kickstarter, Indiegogo, and other types of crowdfunding websites. There's also debt crowdfunding. So Lending Club, Prosper, and other peer-to-peer sites, as well as some real estate debt crowdfunding websites that are emerging in the industry. Last but not least, the focus of CrowdWise, equity crowdfunding. Some of the funding portals shown here, such as WeFunder, StartEngine, SeedInvest, Republic, and Net Capital, round out the top 5, but there are more than 40 currently registered. We do want to note that real estate crowdfunding is also an emergent industry. There's a lot of potential there, and I am an investor in it myself, but it's going to be outside the focus of what we want to focus on here at CrowdWise. In addition, we'll be discussing token offerings, also leading to ICOs or initial coin offerings, but again, the primary focus will be on equity crowdfunding in businesses and products. So, what is equity crowdfunding? Equity crowdfunding, also called regulation crowdfunding, or Reg CF, is where instead of only getting a product or reward in return for your investment dollars, you're going to get actual equity ownership in the company, or future agreement of equity, through something like a convertible note or a SAFE, a simple agreement for future equity. Let's use a quick example to walk through the difference between what something like a Kickstarter campaign would be and how it differs from an equity crowdfunding campaign. In 2012, about 7,500 backers pledged nearly $2.5 million on Kickstarter to support a company called Oculus. Oculus created a VR virtual reality headset, and in 2014, Oculus was acquired by Facebook for $2 billion. Now, what's the difference? Well, instead of only a product, if Oculus had been running an equity crowdfunding campaign, each investor would have made money. A venture capital firm, Andreessen Horowitz, led a round only 3 months prior to that acquisition at a $250 million valuation. That means they made 8x their money. This is a great example how equity crowdfunding can be a win-win for both investors and for the companies. So, equity crowdfunding goes by many names. First, equity crowdfunding, which may include Regulation D and Reg A+, that we'll discuss. Reg CF, Regulation Crowdfunding, and Title III are all the same thing, which is the title under the Jobs Act that allows the companies to raise up to $1.07 million from the crowd. Next, Regulation A+, also called Title IV from the Jobs Act, allows companies to raise up to $50 million. It's also referred to sometimes as crowd investing, investment crowdfunding, and many other names. It's also worth noting some of the funding portals, such as StartEngine, even have their own names for these different types of raises. They refer to Reg CF as a small online public offering and refer to Reg A+ as a large online public offering. So, what does all this mean for investors? Well, it's a new asset class for investment portfolios. That means that investors now have new options for diversification. Typically, when adding to a portfolio, you want to have diversified investments, and startups will probably be negative or less correlated to traditional investments such as stocks, bonds, and real estate. There's also the higher risk, higher reward potential, and New opportunities. Think of all the companies in the private markets that were previously off limits to non-accredited investors. A non-accredited investor is someone who makes under $200,000 a year or has under $1 million in net worth. Thus, if you consider yourself an investor, this is perhaps one of the most important changes since the 1930s, and it's a very exciting time to be investing. Before starting out in any new investment, it's often good to take a look at the risk versus reward trade-offs for that asset class. We're not going to talk too much in depth on this right now, as we'll be getting into more detail in a later lecture, but here's some example returns that we may expect for the Reg CF asset class. In blue are actual returns from angel investing, venture capital, and the public markets, the S&P 500. In red is a white paper that was done in 2018 that provided an estimate for an efficient Reg CF portfolio. And in orange are unrealized returns for actual equity crowdfunding portals currently from the UK and using Regulation D. Again, it's too early to see for Reg CF what the returns will be, but it is reasonable to assume that it should probably fall somewhere between the lower public market equivalent and the upper bound of what the historical actual returns have been from angel and venture capital. Here's a brief table of equity crowdfunding returns in more detail, as shown previously on the graph, but for a deeper discussion, head over to the CrowdWise blog and look for the blog post, What Returns to Expect in Equity Crowdfunding. Another essential component to understanding how the early stage investing works is understanding the different phases of companies. We can think of it as a pyramid. On the bottom of this pyramid are the very high risk but high potential reward companies. Now, as you move up the pyramid, many of those higher risk companies will end up failing. So towards the top, you have the lower risk, lower potential reward. At the bottom, we refer to this as early stage. The early stage phase will encompass several different funding rounds, such as FFF, Friends, Family, and Fools, Angel, Pre-Seed, and Seed stage. Typically, the companies here have little, if any, sales or revenues, and you're going to see the highest failure rates, but because of that, the highest potential returns. Early stage can essentially be discussed as anything prior to Series A. Series A is the next phase, and it's a key transition where the business has to show they can scale. The business has found product market fit, but typically needs that additional capital in order to start scaling. Now, the companies that successfully navigate through Series A will move on to growth in late stage. This is Series B, C, D, or later rounds. The companies are becoming more well-established and well-funded, but many of them are still going to fail before going public. Lastly, for the very few companies that are listed via an initial public offering, IPO, or a direct listing, these are the most mature and some of the largest companies that are out there. When we look at equity crowdfunding, you're primarily going to see most of the companies listed under the early stage and perhaps some getting into the Series A or growth later stages. Most of the early stage will be under Reg CF, since that's up to a 1.07 million cap, while some of the Series A or growth late stage may be getting into Regulation A+, up to that 50 million raise cap. Another important thing to understand is the types of investors that are going to be involved by business phase. On the x-axis, we have the various phases from the previous chart: early stage, Series A, growth, late stage, and IPO. So typically, angels are going to be involved in the early stage. Next, venture capital firms typically come in around Series A and then lead some of the later rounds. This doesn't mean that there aren't venture capital firms that will go earlier into the seed stages or invest alongside angels, but again, for the most part, they'll invest around Series A and growth late stages. As companies become more mature, often private equity firms will come in. These are much larger investment firms that will look to take on majority ownership of the company, whereas venture capital may only be looking for 10 to 20% to place many small bets. Private equity firms are looking to take on majority ownership to help get the company to that finish line before a public offering. And of course, the last stage is going public, whether that's through an IPO, initial public offering, or a direct listing. Again, these are not hard and defined lines, but it can be used as a guideline in terms of the types of investors to expect by business phase. I believe that most investors can be grouped under 4 types of categories for equity crowdfunding investing. First, probably one of the largest groups, the capitalist. These are the people looking for capital appreciation to make money on their investments. Next, there is the pupil. This is an educational investor, perhaps looking to brush up on their business skills, gain new skills, and gain networking. Then, the thrill seeker. Investing in startups is exciting. There's a lot of energy and passion being on the cutting edge, and so investing as a thrill seeker is definitely one aspect of it. Lastly, but definitely not least, the shaper. These are the investors who are investing because they want to give back or help shape the future. So think about this. Ask yourself now, where do you think you fall on these various axes? Are you perhaps more of a capitalist and looking to gain some of that excitement and energy? Or are you perhaps looking to invest more because you want to give back, social impact investing, or helping to shape the future? Having a good understanding of where you fall on these axes will help to shape your investment strategy as you get started. So ask yourself, why are you investing? And what does your why profile look like? We've discussed at this point some of the benefits for investors, but why do businesses use Reg CF? First, there's lower fees and less paperwork. It doesn't make sense to hold some of these early stage companies to the same high, strict standards as a company that would be trying to do an IPO. From Crowdfund Capital Advisors' 2018 report, Reg CF is likely the most efficient, cost-effective way to raise capital for startups and SMEs. Also, you're going to be creating many brand champions. Instead of just one or two angel investors, think of the potential benefit of having 200, 500, even thousands of investors that are also going to be sharing this with their friends. Because of that, you get network effects. And of course, it's an alternative to traditional finance, whether that's venture capital, taking on debt through bank loans or credit cards, and other ways. It's interesting to note, currently, Reg CF boasts a 60% success rate for campaigns versus only a 6.5% success rate for VC. Now, Reg CF has a lot going for it, but as of early 2019, there are still some obstacles to be overcome. First, Jobs Act 3.0 legislation is needed. This is because some of the current laws greatly limit the potential of Reg CF. Some of the things that would help are single-purpose vehicles that would help protect investors, Exchange Act reporting exemption under Section 12G, and raising the current $1.07 million cap to allow more funds to be raised. As discussed, the results are also very uncertain right now in terms of what the returns will be. It's unknown if the high risk will be compensated with higher rewards, but that will be something that we'll be monitoring and reporting on CrowdWise. Lastly, adoption and awareness. Entrepreneurs and all types of investors, whether personal or professional VCs and angels, need to become more familiar with Reg CF. So, how and where do you begin? If you haven't already, head over to academy.crowdwise.org and create your free account. This is going to get you access to 20+ investor courses, all the way from novice through advanced, as well as the additional learning aids. Head over to the funding portals. A few are shown here, WeFunder, Start Engine being two of the biggest currently, but also Republic, Net Capital, and Seed Invest, rounding out the top 5 currently as of 2019. Lastly, there are other services that are popping up. KingsCrowd is an independent deal rating service that helps to do due diligence and to help you screen your deals. In addition, NewChip is a deal aggregator. This means they look out across the various funding portals to pull the deals together all in one place. You can do searches and also track your portfolio. Now, both of these companies are startups themselves, and I need to make a disclaimer that I am an investor in both of these companies since they did raises on equity crowdfunding sites themselves. However, I'm only going to be recommending those services that I really believe will help you in your investing and that I use myself, which is why both of these are on here. So, what to expect next lesson? We'll be giving you an introduction to private markets and how they differ from public. We'll be going over the Jobs Act and regulation crowdfunding legislation. We'll be discussing the current state of the regulation crowdfunding industry. And we'll talk about why Reg CF is so important to the future of startups and investors. Thank you. Again, create your free account if you haven't already. For questions or feedback, send us an email, brian@crowdwise.org. And please, if you find this helpful or useful, feel free to share on social and connect with us. Thank you again, and we'll see you back here for the next lesson.